Okay, hi. My name is Jay Norris. Hi, Boyke. Good afternoon. My name is Jay Norris, and welcome to our webinar, which we call Live Market Exercise, which is also the same title for something we do for our clients, which is produce live market analysis. I think it's very important. Definitely transparency in this business. I think really the only way to teach, the only way to lead really is from the front, and the way you do that is in live markets. So I'm also a university. I'm the director of learning at IBUniversity, and thanks for attending. As always, we need to remind you guys that trading futures and forex is a risky endeavor and not suitable for all investors. We certainly mean that, because of the emotions brought on, because of the money, really. A great trader who was also a therapist before he was a trader, he was a doctor in psychology. He said that money is very, very similar. When you show anybody money, it's very, very similar to the first time that a juvenile boy might look at a Playboy magazine or something, okay? The boy is not going to make sense. He's going to start making decisions he wouldn't normally make. The same thing for adults when it comes to money, and nowhere is it more apparent that the money appears to be easier than in a market. So we definitely are serious when we put that disclaimer on it. It's a mesmerizing business. Know that ahead of time. Also, some of the techniques I demonstrate are proprietary and should not be retaught or retransmitted in any way. And, I had to add that legalese today, and I'm telling you, I missed a trade because of this. You got to take compliance seriously. And, I was looking over some things today. I'm like, I better make that adjustment. And, it's a necessary evil. It really is. But you have to say that. And, you have to remind people of that. Hey, I'm all for you guys taking what I'm showing you and using it to improve your trading. I'm all for that. Now, I'll show you momentarily that trade I missed because I had to take care of some business. I prefer to focus on trading first and teaching second. And as I said, compliance necessary evil. Anyway, my name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade. Which is to say, anyone with a ton of experience. Actually, I have over 30 years of experience now. It's been a long time. I worked on the trading floor. All that is to say that I survived for 20 years on a trading floor, and any experienced trader is going to understand that. It doesn't necessarily give me an edge now, certainly on the screen, but you learn a lot about the mind and about risk and about people on a trading floor too. So it was invaluable experience to me, but believe me, you guys, I don't have any advantage over you now. We're all equal on the screen. If anything, I think the game's gotten a lot better because it's a lot more affordable too for everybody. And certainly we've seen the spreads come in and the commission come down. So I'm very excited about trading going forward. I'll show you how excited I am. I'm manic about it today because I had to work on that disclosure and do a little legalese for the company, and it cost me a trade. I missed a trade, and we'll show that to you momentarily. I've written a couple of books on trading, which were published by McGraw-Hill. I'm proud of that. Anyone who's ever written a book understands how hard that is. Literally, you're wearing sunglasses when you're trying to edit the book for that final time, and that's even before it goes to the publisher. So a book will wear you out. You get stress headaches. My hat's off to anyone who wrote a book, who's ever written a book. I doubt I would do it again. I doubt very seriously I would do it again. Writing a book, my mother told me how hard it was to have a kid. She said, I can't believe I had 7 of you kids because after the first one, I swore it off. But it's funny. I guess delivering kids is a lot more worthwhile than writing books, though, because I don't think I could write another one. It's a lot of work. Anyway, the tactic we're going to show you today is highlighted in this book on the right, Mastering Trade Selection and Management. And that's how to identify direction in any market on any time frame. And hopefully that's what you guys showed up for. It's an interesting tactic and one you need to know because what does that mean? I can identify direction on any market on any time frame. That's a trigger to me. I'll tell you, being able to identify direction is all about a trigger. Direction is a trigger. Pattern is trade selection. Direction is trigger. What makes my books unique is that they both include trading plans which allow you to backtest the information provided. Transparency extremely important for us. I was trying to make that point last week. Transparency is important for you guys too. If you think you want to be a trader, be it as a hobby or be it even as a profession, you have to be honest with yourself. You have to be transparent. You have to be able to see that the method you're following is going to work for you. You need to know what your, overall, you need to have a really good idea what the winning percentage is. Otherwise, you're not going to have confidence. Without knowing that winning percentage and that win-loss ratio, you're going to have all kinds of problems. You're going to have, fear of having a poor method. You're going to have fear of event risk. You're going to have all kinds of fears. So you got to be honest with yourself. And that's why it's very important. I say these books are unique because they give you a trading plan that allows you to back test the information in there. Transparency, very, very important to us. The book serves the text for our courses. I'm also a professor at IBUniversity.com, and I'm the founder of Trading University here in the Chicago area. Very proud of all that stuff. I tell you what, my solution to teaching not getting in the way of trading has always been to teach in live markets. And I think that should be the standard nowadays. I don't think there's anything wrong with giving individuals courses and quizzes to take on their own time, but I think if you teach trading, you better do it in live markets. Trying Trader, I've read the second book. Oh, thank you very much. It's definitely worthwhile to get the first book. I think they're very different. The philosophies are the same, but to me, you have to have that. I was just, before I came on today, as far as getting ideas, because I always want to give you new things, I was reviewing our courses, and I was playing through the graduate section on trader psychology, and I'm like, wow, this is such good stuff, but I wouldn't even know where to start as far as getting that information in your hands, other than to say that, hey, you have to recognize your own thought recognition patterns. But no, the first book, it's all going to reinforce itself, Trying Trader. So, I'm trying to answer that question specifically, and I'm honestly, I'm kind of drawing a blank. It's a long time since I wrote that, even though it was 2009. But no, there's probably more background information on the psychology of trading in the first book. And I know you guys all want to talk methodology, me too. The number one people lose money is because they don't have a thorough method. But even with a thorough method, people are still going to lose because they don't understand trading. They don't understand their own psychology. They're not available. They're just tuned out into recognizing their own thought process. They don't get it that their thoughts create their feelings create the actions. All that's in the first book. So yeah, get that first book. Without that knowledge, without understanding your own thought recognition patterns, you're not going to recognize when your thoughts are causing you problems. Think about that. When your mind creates a thought, the thought creates a feeling, the feeling creates action, right? That gets in the way of your trading. Those three steps are going to kill you as a trader. You do not want to be reacting to your thoughts, whether you know it or not. And believe it or not, I guarantee 99% of us, we react to our own feelings and needs. We act upon the thought that created the feeling that tells us we need something. Really, we're emotional wrecks on our own from a trader's perspective. The only thing you're to react to is market-generated information. I don't care what's going on in your life, even your health, even your mind. You can only react to market-generated data. And I think once you know that, I think that's a huge strength for you. And, at that point, you can ask for strength from a higher being for anything. And mainly, hey, God, just help me focus on what price does. Make sure I only react to market-generated data. And believe me, I think he'll soothe. He can it's just an odd thing. Anyway, I don't want to get too philosophical on you, but you want to learn to react to price only. And the first book, I think, covers that a bit more. Trading philosophy, definitely our belief system. Before we get into this, I'm going to show you a trade from this morning because it's still going on. It's kicking me in the pants here. Okay, everyone see the chart? It's a 15-minute euro-dollar chart. I'm sorry, Aussie-US dollar chart. Let me scrunch it down so everyone can see it. Everyone sees the Aussie 15-minute chart, right? Oh, that's a great question, GY. We'll cover that as we go along. You become emotionless by a lot of back testing. I mean, I've added it up conservatively over 20,000 hours on the screen just with this method alone. Really, the last 2,500 were essential. A lot of time on the screen, but it starts with a method, GY. It really does. Here's a chart of the 15-minute Aussie dollar chart, and I'm going to scrunch that up, and I'm going to show you. And this is some of the proprietary information I touched on. Here, let me get rid of that cursor. See the bands on the chart? These are what we call price pattern zones, and they're based on simple geometric measurements. Someone with an advanced degree might use that term. Oh, they're price pattern zones based on geometric measurements. Someone on a trading floor would say, oh, they're marking higher lows. Either description is apropos, but I would say higher lows. Okay, they're marking higher lows. And you would have had the same pattern zones back here too, but I removed them because there'd be too many lines on the chart. So today you came and look at my pattern zone there. You got right into it. Happened to be a trend line there too, right? So you had the confluence of the trend line and the pattern zone. Let me drop down to the 3-minute chart, and you'll see where that. Well, let me show you the pattern zone initially here, and where that came from. There you go. See, I use my retracement tool. I slap it on there. I mark it. So that's where it came from. So when price is dropping down, and look at it, look at the momentum is dropping like a stone, and here you are, and everyone thinks the world's coming to an end, and the Aussie's going to collapse. What happens? It gets on my trend line. It gets the confluence of the trend line and the pattern zone, and there you go. And here's how I'll get it down and dirty. I'm all the way on a 1-minute chart. I'm in right here. I'm not messing around. I won't even go with the limit. I'll just hit the market button right there. And what was that price? Somewhere around 102.40 or so. So you got in the zone, and there's where you want to be. Now, why is this zone very attractive to me, and why I feel that you had a rip-roaring rally coming out of there? Here, let me draw a zone on top too to make sure. Let me see where my profit target is. My profit that I don't have because I was working out some legalese there. Let me just copy that guy up there. That would be my my target on the upside. Now, why is this particular pattern so important to me, just as this was? That's right, Fuji Kimbo, trade like a robot. Yeah, I'll give you a link. I was just listening to this tape, and I love it. Hopefully I don't throw you guys off. I won't lose my screen because I'm showing you this. I'll send you guys the link for it. This is a cool one. And let me turn that off before it kicks me off. Okay, hopefully everyone can still see the screen here. That's a cool one. As far as GY, how to be emotionless, they have great free tapes on YouTube now that really get you in the zone. They mimic. They teach you how to take you. They teach you how to take you into a meditative state a lot quicker than you can on your own money, on your own time. And GY, it is your own money, and the market is moving constantly. How to be like a robot. Right. Well, GY, you have some fears that you have to overcome, and those are normal. You probably have fear of event risk. You have fear of that your method isn't sound enough, and there's a term for it. Can't think of it coming to mind now. But we definitely cover those fears in our courses too. And by the way, our course is coming out hopefully next week. It's like 20 pips a month for you guys. We let you pay monthly. We give you all the material up front. If you don't like it, drop out. If you like it, continue on. You pay your 20 pips a month, and we cover all those fears there. Yeah, Philip J. Yeah, music is amazing. It truly is amazing as far as getting you into the zone. But QY, or I'm sorry, GY, you've got to have the method down cold, though, before the music is going to help you. No matter if you don't have the proper method, and we'll get to this in a moment, you don't have the proper method, no amount of meditation, no amount of training, no mantra in the world is going to help you, because subconsciously you know you shouldn't be trading, because subconsciously you know that your method's not strong enough. I know a trader where he insists that because he lost a lot of money with Bernie Madoff, that's why he can't trade. And I've tried to tell him in a polite way that the reason he can't trade is because his method is not good enough, but he's not going to listen to that. He's oversimplified. He's focused on direction, not pattern. But you can't tell someone, especially as it starts getting up there in years, that they're doing it the wrong way. They're not going to listen. It's funny. So that's right. All you guys are right with the meditation. Trying trader, no, you get on that initial subscription, you get access to our advanced and our graduate courses. So the core concepts, the core concepts 3 is important stuff to have. That is core concepts. You need that. But our advanced course will change the way you look at markets. You're looking at this chart right now. This should change the way you look at markets once you understand how that zone works. Now, back to the chart. Why is the zone so important? Why do I think market reacted that way? Well, a couple of reasons. Number one, you had a lot of zones combined. I just popped out to a weekly chart. Forgive all the lines. The weekly chart, I could see that here's my zone on the weekly chart. You can see I had a double bottom on the purple line. That's a double bottom on a 50% line. So my primary zone is bullish. I can go to a daily chart. Well, to me, it's bullish because I see the pattern. So my daily is bullish, but let me show you a specific pattern as to why. There it is. See that pattern right there, that green line? Similar? That's the same geometric measurement you had on the higher time frame. Here, I'll show you that. See that line right there, that higher low? That's the second pattern aligned. Now come down to today's chart on the 15-minute. And I will show you, brothers and sisters, why this third one is so convenient for us as a trader, because that was the third pattern aligned. So you had a double bottom on the weekly, then you had a couple of V bottoms on the green line. This is the third one. That is a key level. That's I erased my line there on accident, I think. That is why that's a key level, because I love it when I have 3 patterns aligned. Yesterday, it was real cool in the Aussie because we actually had 3 patterns aligned south. You had actually 4 patterns aligned up and 3 down. So I was on the short side in the Aussie briefly. Where was that? Here. Very short-term chart. You don't see it, but I'm not going to get into that. But let's stick with the layup. As Minnesota is the great pool player Minnesota Fat said, always take the duck. That's a duck trade, as it was here yesterday too, because that's in the zone. See, I got a triple bottom on the zone or a V bottom at the bottom of the zone. So that's why today that's an attractive setup for us because it was in the zone and those price pattern zones. That's proprietary for us, but it's very valuable. I want you guys to use that stuff to make money for yourself, but obviously, it is ours, right? Praveen, no, I can't. Well, the zones are based on a geometric measurement that never changes. It's essentially a retracement. The zone ensures that we're buying dips in an uptrend or selling rallies in a downtrend. Boy, no, not yet. No, I don't want to. I'd prefer to. That's a lot of work. I was just actually starting to set all that up, and I had the misfortune of having both my futures and forex account at that broker's firm whose owner just scammed $200 million and tried to kill himself. That was not good, and that was a part of the plan. And thank God I didn't do that sooner because people. Yes, all right, yes, that's right. So thank God you didn't say that a year ago because you would have lost the money. Boki had something. He was very close. Do you mean 3 aligned in 3 time frames or on 1 time frame? No. It's 3 different time zones, and they don't have to be sequential either. You have to know. You got to know. You have to be able to identify price patterns. To me, there's 7 of them. Really, 5 of them are tradable. Okay, so that's the trade that I missed. You see on the 1 minute because, you have to take care of business too. So, but that's a beauty. That's a layup. You can see it a little more better on the 3 minute too. Look at that! Wow, and that's the V bottom. I love the V bottom at the bottom of the zone. So the zone, the trading zone itself, proprietary information. Essentially, it's a geometric measurement that's pretty simple, and it's been around. If you read the book, The Dow Theory. Robert Ray's book, The Dow Theory, written a little less than 100 years ago. That's where I first learned about pattern zones. It's the most effective book yet. There's a lot of them. Reminiscence of a Stock Operator is going to teach you about the mindset you need to be a trader. And it's because of Reminiscence of a Stock Operator that it bothered me for about 2 days that I lost all my trading capital in PFG. You got to go on. Reminiscence Stock Operator, you couldn't keep that guy down, The Dow Theory is a great book, and it helped me in my education efforts. A trying trader, what advice can you give to maximize your exits or let your profits run? MACD is a great tool for letting the profits run. I'm trying out. I adjusted my MACD to Bill Williams' old 534 awesome oscillator, but the MACD is a very good one to let your profits run. Just any kind of lagging indicator is going to help you let a profit run. I'm excited to see that the Aussie's getting above that line because there's another line up here. There it is, up there. I think that, and you guys have been reading my Seeking Alpha blog. I haven't been writing the blog so much because I've been occupied with problems with that whole PFG business, but I've been saying all along that 104 and change is my mid-summer target. I think that's where you're going to get. I think that's where the Aussie's going. But it took a ride this morning. Yeah, Livermore used the bug. I know that's what's not fair about Philip J. about PFG. PFG, I mean, they're a huge broker. The NFA was on them like, white on rice. I mean, anyway, the money's gone. Livermore worked the bucket shops. Well, basically the bucket shops are, to me, the IVs are bucket shops, but not really though. They don't make markets. Mike, I mainly trade. Nowadays I'm trading. He said I do trade a 50-minute, 3-minute, but lately I'm on a 3-minute. Here's my 3-minute, and I'll be on a tick chart too. There's the 3-minute, and here's my tick chart. Like, look at the tick chart in there. But no, the 1 minute too will work for you. Maybe a 3-minute or a 1 minute. Look at the 1 minute it gives me because when I go all the way down to a 1 minute when I have 3 patterns aligned. When I'm looking at 3 patterns aligned like that, I'm down the dirty on the 1 minute because I'll start popping that stuff. I'll get in there. Once I get it on the 1 minute, boom, I'm in with a stop. Like I'm in with a stop. Goes on the 3-minute goes, I'm in. I put another stop. The 15 goes, I may put. I may go in again. Well, by this time, it's already up here at already nice profit. By then, I'm already going to break even stops. But no, I'll start layering that position on in the 1 minute, then the 3-minute. I got some catching up to do now, right? The whole business. GY do you think a beginner should trade? I can't answer that question. I'd have to know the method that you're using. Oh, yeah, boy, you got to let the profit run. The reason you absolutely have to trade multiple contracts, the biggest mistake I made in the past couple of years is not trading more contracts. You have to trade multiple contracts because you can get out. Like, I may get out. I know this is a trend trade, so let me see on a 3-minute. If I know it's a trend trade, I'm probably going to get out around 20, well, the Aussie, I'll say 20, 25 pips. So I may be coming out of this trade on 20, 25 pips, so that's 5, 10, 15, 20. Somewhere in here, I'll come out of a portion. I'll come on my first tranche. I'll come out of the second contract here. I'll let that third one go, and I'll manage it using the MACD on the 15-minute. So on my last contract, I have a break-even stop. I'm letting it run on the 15. If the 15 goes, I'll let it go on the 4-hour. I haven't even looked at my 4-hour lately. So that last one, you always have to let run because you never know when the big one is going to come. And there, see, I'll manage the last one on the 4-hour. So you have to trade multiple, at least 2 contracts. If I'm day trading, even if it's a counter trend trade, take one off at 12.5 pips, and then manage the second one on the MACD or any kind of lagging indicator for the time frame you're using. If it keeps going, use the next higher time frame. Borat, position trader. For me, no. A position trader would have that. Bill Williams would tell you he loses more trades than he wins, but he adds on when he starts going. For a position trader, yeah, 30%. If you're trading off a daily, yeah. But me, I couldn't handle that low of a winning percentage. I'm low. I'm down and dirty on these lower time frames because I want that higher winning percentage. You know, if you're trading a higher, like the higher the time frame, the more the risk. If I'm trading a 15-minute time frame, I'm looking at like 1-to-1 risk reward. If I'm down and dirty on a 3-minute or even a 1-minute, I can really stretch that win-loss, that risk reward ratio, 2.5, 3 to 1. Or I don't know. It depends on. He's asking about the risk reward. It depends on the time frame I'm trading. Lately, I'm loving these low volatility markets. I love a bull market because there's low volatility. Let's look at the. I'll go on a 3-minute. When I got 3 patterns aligned, I'm in. See that little inside candle? We teach this in our core concepts. See the inside candle? Once you close above the high of the inside candle, that's a buy signal. I'm in there. So if I'm in at 44 or so, 43, 44, look, my stop is below 35. So I'm risking 10 pips on that trade. Because it's a trend trade, I'm looking for 20, 25 pips. So I'm looking at 2.5 to 1 risk reward on the 3-minute. But hey, let's get back to the PowerPoint. It's easy to point out what just happened in the market, but it's a whole other thing to understand why these things are happening. Boyke, I only go down on those lower time frames I'm at an area of interest where I have 3 patterns aligned, and I see that pattern hold too. I mean, I see on the 1-minute. Look at how that market just stopped. Boom. That was my lowest closing candle, right? Now, by the way, I'm not going to wait for a full-blown change of direction because I've got 3 patterns aligned. But bam, it hits the brick. Look at that. Boom, boom, boom. So I got. What is that? 1, 2, 3, 4. I got 5 minutes to see that my support line's holding. I have 3 patterns aligned. So, yeah, if you look at that low of a time frame all day long, your eyes will pop out of your head. You see, did I get 2 closes above that orange line? Not yet. So I got to keep that orange line in there. Yeah, GY, it's so hard to get that. If you're looking for 50 pips, you're generally going to have you're going to have to trade a higher time frame chart. Yeah, I've got a whole lot of experience. And I tell you what, the last year's experience was just priceless to me. Keep in mind, though, for 20 pips a month, you get in our program, and, I'm so excited I'm so excited for people that, are in a position where, oh my God, I'm going to retire one of these days and I'm going to have to live off that. But if you can learn to have the confidence I have now in a demo account, I think it'll be easier for you guys to learn the method than me, because when you're creating the method, you always have a little bit more doubt than someone who sees it afterwards, because, the scientist, he can never quite fully believe all his data until years and years. You guys can see it, and so you'll be like, yeah, this is it. Okay, let me get back to the PowerPoint here. Okay, your philosophy, our belief system. Your belief system is going to get in the way. Okay, it's going to get in the way. Why is it going to get in the way? Because you're not going to agree with things that are going on out there. GY, we'll take a look at those yen pairs once we run through this. Hopefully we'll have time. These are two very, very important points to understand, that you may have a conflict with what markets are doing and you may not know it. Very powerful Keynesian influence at work in the market today, right now, right? What the central bankers are doing, what's going on. The solution for the problems in Europe are going to be pure Keynesian, okay, or Keynesian, however you pronounce it. I'm from Chicago, I say Keynesian, right? So whatever the solution in Europe, it's going to be pure Keynesianism. Okay, so you have to recognize if your own belief system and your own feelings are out of line with central bankers' policies. And you have to hit yourself in the head with a ruler to stop feeling that what the central bankers are doing is wrong, okay? We're not here to trade the moral high ground. We're not here to determine what's right or wrong and then trade. We're here to make money. So you darn well better make sure that you're not going to argue with the central bank of the ECB, the European Central Bank, or the Federal Reserve, or any other central bank. You're not here to argue with them. You're here to make money. So you know how you get around this, the moral high ground if you feel that they shouldn't be giving away money to improve the economies and to prop up stock markets and to keep the whole thing together. If you disagree with that, the way around that is focus on price only. If you focus on price only, you're going to get to my second point. Price pattern is a reflection of all fundamental development. So you're only going to act on market-generated data. You're no longer going to argue with the ECB or the Fed. You're not going to get angry at politicians. You're not going to get emotional in any way. You're going to look at it very objectively. You're going to wait for the patterns to be aligned, and then you're going to wait for direction. You're going to wait for the patterns to all be aligned. Then you're going to wait for short-term direction to change in line with that pattern, and then you're going to have some fun, okay? So you're going to act only on market-generated data only. Once you learn the secret of acting only on market-generated data, once you learn the secret to seeing how powerful price patterns are, nothing is going to bother you again. You're going to be like, wow. You're going to be completely neutral. I'll tell you a quick story. I'm a big follower of the Tao Te Ching, right? And I believe I'm centered, and I know the power of meditation, right? And I thought I knew a lot of things, right? The older you get, the less you know, right? But I'm pretty well grounded. I'm pretty well centered. I heard something this week that blew my mind because I thought I was centered. And I'm not one to choose sides. I remain open, and I just want to go where the market wants to take me, right? I was watching the Colbert Report, that funny guy, Stephen Colbert, and he had Melinda Gates on there. Melinda Gates, of course, is the co-chair of the Melinda and whatever Gates' first name, right? Bob Gates or whatever, the Gates Foundation, anyway. Melinda, who's the wife of Gates, the founder of Microsoft, was talking about how she had just allocated $500 million to women around the world, primarily in Africa, to help them with their family planning. Because if they have children too quickly, that doesn't work. They have children at such a young age, it's not healthy. They continue to have children year after year. They're not going to be able to get their fields planted. They're not going to be able to raise a strong family. So the Gates Foundation went in and they offered they're giving $500 million away to help with family planning for these women. And Stephen Colbert, who's a funny guy, thinks, he's a funny guy. he was saying, wow, so you're giving $500 million away. He said, why don't you, he said, with that kind of money, you can hand choose who runs for Congress in this country. And she said, no, we don't want to do that. We're neutral. And he goes, what do you mean? Come on, you're neutral, right? She goes, yes, we're neutral. And he said, literally, with that kind of money, you could put whoever you want in office. She said, yes, but we need to be able to work with whoever people elect to be in office. Now, I thought about that for a moment. I hope I'm not losing you here, because to me that was such an important point. She has the money to control she could probably go a long ways in putting politicians who she wants to see in place that will implement her policies. She has that power. No. Here's real power. She's not interested in trying to control who's going to be the politician. She's out there fighting the good fight. She knows she has to work with both of them. Now, I thought, Bill, thank you, Boyke, Bill Gates. I couldn't remember his first name. Now, this really blew me away, because even though I say I hang on to the center, sometimes, no, I do take sides, and there's going to be times where an opinion slips in my head. But, I mean, that was so powerful to me that she said, no, we're not interested in trying to control who's the politician. We have to work with everybody. Anyway, a trader can learn from that, because if you can get to that point, you truly do not have an opinion, and you're just going to go along with where the market wants to take you. So that her thinking kind of blew me away. And we all have to think of that as a trader. We cannot focus on, we can't get caught up in what the central bankers are doing if we disagree with it. We just have to focus on market-generated data. So only act on market-generated data, and you're automatically going to stay on the center point, and you're going to avoid having an opinion. Because you can't have an opinion as a trader, because it's going to bite you. Why do all these guys lose money? Why do year in, year out we hear about the big banks, Chase most recently, losing tons of money? Because they let some trader who had to get lucky for a couple of years, and they thought he knew what he was talking about, and all he had was an opinion, and they let him, they give him a bunch of money and tell him, hey, go at it. And what happens? He ends up losing a ton of money, because they don't know what they're doing when it comes to directional trading. No one is going to make money as a directional trader if you hold on to opinion for too long. So you have to recognize what the market's doing. You're never going to bully the market around, but it's going to be fairly simple to go along with where the market wants to go, like that Aussie dollar trade today that I would have showed you. And GY, you'll get those 50 pips if you're in the right place at the right time and you're allowing a profit to run. You get in there, get in the trade, risk a little bit, it starts going, take a portion off, and then let it run. And then that's how you get the bigger money. So yeah, you cannot have an opinion. You got to hold on to the center. Don't care which way the market wants to go. You're just there to go along with the market. So this second point is very important. Price pattern is a reflection of all fundamental developments. So you don't have to hang on every news story. Understand that the pattern is already a reflection of that, and then act only on market-generated data. So I'm a big method guy. You have to have a robust trading method which works in all environments. And you have to have positive trade expectancy, too. If you don't have positive trade expectancy, you're not going to be able to pull the trigger. And you're going to be asking yourself, gee, why don't I pull the trigger? I have to work on my psychology. No amount of psychological work is going to help you if you have negative trade expectancy. If you know subconsciously that you're going to lose more than you're going to win, you're not going to be able to pull the trigger. It all comes back to your trading method. You have to be honest with yourself. You have to be transparent with yourself. You have to back test the devil out of that thing. You have to demo trade the heck out of it. And that's why I spent all my time doing exactly that. And now it's not a big deal. It's unfortunate when something like PFG happens, but it's not the end of the world because you have a really good idea what you can do, and you're excited about that going forward. Does using an inside bar as a trigger candle get you in a trade quicker and because waiting for a change of direction? Yeah. A lot of times, I have 4 different triggers now. It changes sometimes. In the case of that Aussie trade I was showing you, on the 3-minute, the lowest closing candle is a benchmark candle. You don't want to wait for COD. You get an inside candle there. You could take a trigger on a close above it, but only if you have 3 patterns aligned. I had 3 patterns to the tick aligned. And I'll show you momentarily. The U.S. stock market, the E-mini S&P, did the exact same thing on the exact same level. The Aussie yen did the exact same thing at the exact same geometric level too. And I'm looking at dollar CAD, and it looks like dollar CAD topped at the same geometric level also. So the dollar pairs all topped, and the asset class markets bottomed. Yeah, look at that. The dollar CAD topped at that same geometric measurement, which we teach you. That's the first thing we teach you in our advanced course. I'm telling you, you take our advanced course, $200 a month, boom, man, it'll change the way you look at markets. Boyke, the pattern is your best friend. Pattern. Boyke, did you buy that book yet? It's none of my business. I'm not here to sell books. Okay, the robust trading method works in all environments. You have to have that. You have to be able to explain that method. It's got to be really easily explained. I even, Boyke's okay. I've even simplified mine. Remember the first time I was on here, I simplified my method. I explained it in 3 points. And I think it was Boyke. You said, boy, that's a mouthful. Someone said, that's a mouthful. Okay, I've simplified it even further. Here's my method. And whatever method you're using, who's ever teaching it to you, better be able to explain it very simply, very easily, and understand it too. So we focus on markets with low non-systemic risk, such as international currencies, and we look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. Okay? Another way of saying, a more simple way of saying that is we want to trade when the day-to-day news flow is aligned with the majority of patterns. Trade when direction is aligned with the majority of the patterns. Soul man, you're close to it. It's a formula would be more of a mechanical thing. Pattern is more a concept. So it's not a formula, it's a concept. Yeah, 20 pips a month, you're going to be in business with us. I think next week we should be able to roll that out. I'm going down into the technology department with a ruler again today. But they're not afraid of me anymore. They're just not afraid of me. Now they just see me come and they start laughing. Yeah, it'll be done when it's done. But, securing video delivery, it's a challenge. That's why you see everyone has YouTube out there and everyone gives it away because they don't have a way to secure it. Yeah, try. I need the whip this time. But, yeah, that's it. We focus on markets with low non-systemic risk. Look at the Aussie. AAA rated currency has a nice yield to it. And we focus on those times when day-to-day news flow is aligned with the primary or secondary pattern. I showed you in the Aussie, everything's aligned. In the Aussie, you're real close to shifting that secondary pattern too, but you definitely have the majority patterns higher. No, Philip J., no, that's not a mini. That's 20 pips on a standard contract. If we can figure out a way to have a government agency or even the brokers subsidize the cost of that, I'll be the first to give it away. I'll be the first to say it's free to you because someone else, is helping subsidize the cost of it. That's my goal, to be able to have a firm or even the government subsidize the cost of it. Because if you think about it, if you could teach someone how to, even take a $1,000 account and get a little bit of return on his money over time, that's to me that's a beneficial thing, right? So hey, let me get back on point here. Can you guys still see the screen? So here's the question: how can we help to improve your trade selection? Okay, you're seeing the PowerPoint too, right? And basically, we're here to show you how when direction is aligned with price pattern, and that's exactly what I showed you in that Euro chart. When it was aligned. So here's price pattern real quick. We all know price pattern. You can identify that with the naked eye, right? This is the Euro. We identified price pattern back in April. Guess what? The Euro's all the way down here. No surprise. You had a bearish price pattern, right? So here's price pattern again, where we look, and this is fractal geometry at work. See the eyes left on the chart, boom, 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 that the three impulses of the legs up. what that is doing is it's a harbinger of the overall pattern. There's your 3 impulse moves up also. So price pattern, pretty simple. We're looking for that point where direction changes in line with the pattern. Very simple, but very important. Here's scalability. You see the pattern, that's Mandelbrot's generator. We refer to that zigzag as. And then if you look at the white lines on the right side of the chart, boom, 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 you see what happened. The overall pattern was replicated on the lower time frames. Eyes right there, and you see boom, boom, boom. It did it again. That little zigzag pattern, it's just going to replicate the higher time frames. So fascinating stuff. Uh-oh, we see both my screens here. That's not good here. Okay, how about there? So scalability, repetition. Here's repetition. It's a beautiful thing. Once a market gets in a what we call a negative growth pattern, or whatever the pattern can be negative, positive. Once it's in a pattern, once it's showing a pattern, just like that Aussie I showed you, the live trade or from this morning, the market holds that pattern. So this is a negative growth curve. A scientist will call it a negative growth curve. A trader will say, oh, it's a pattern of lower highs and lower lows. So when you see those lower lows, they tend to repeat themselves. So we're just seeing repetition, and this is back in March. Guess what happened in April, May? Same thing. Same thing. You're in a bear market or a downtrend anyway. So we count on that scalability and repetition. So once again, we're looking for those times when direction shifts in line with the pattern, change direction in line with the pattern. How do we define? Here's another example of when direction shifts in line with the pattern. And again, price is all the way down here, right, following that sell signal in May and June. So how do we define a change of direction? A change of direction is when we have both a trend line break plus a directional line shift. If you want to know what the directional line shift is, it's in Chapter 3 of that book, Mastery, Trade Selection, and Management. We'll try to encapsulate it real quick today for you to define it. The directional line defined when the low of the highest closing candle, well, the directional line itself, the low of the highest closing candle in an uptrend, or the high of the lowest closing candle in a downtrend. Directional line is used if price is closing below the directional line, direction is up. If price is closing above the directional line, direction is down. Now, this directional line, it's a trigger. It's not going to help you with trade selection. It's going to help you with when to get in the trade. And here's an example of it. Remember I said it's the low of the highest closing candle in an uptrend. There's the highest closing candle in an uptrend. There's the low. Once price closes below both the low of the highest closing candle and the trend line, then you have what we call a reversal. We call it a change of direction. You call it a reversal. So price reversal equals trend line shift plus directional line shift, right? Worth repeating. Trend line shift plus directional line shift. Here's the lowest closing candle. Once price penetrates the high of the lowest closing candle and the uptrend line, so you take out the trend line, you take out the high of the lowest closing, the high of the lowest closing candle, then we have what we call a change of direction. Those are what you want. Okay, cool. That change direction line is critical because that's going to be your trigger. And if you want to, easiest way to learn much more in detail, get the book Mastery Trade Selection and Management by McGraw-Hill, Chapter 3. Let me show you examples of this today on the 3-minute chart. Well, I'm always hesitant to do it on the lower time frame because it's kind of confusing. So we'll do it on the 15-minute. I'll automate this. Okay, there's the 15-minute, the blue line. Let me just change something real quick so we can do a back test. Here, let me just highlight, make sure the blue line stays on so we can see that. The blue line is the directional line on the 15-minute chart. It's marking the low of the highest closing candle in this case. Now, I'll show you how this moves through time. Let me just turn off my 240 and my daily and all that other stuff so it's not in the way. Okay, so we're seeing only the 15-minute. Now I'll go back in time, and you guys, here, let me scoot the chart up. So you could see, we'll see what happened coming up to the that pattern zone. So I know that this is my third pattern. I know that if that pattern, just like yesterday, this is a third pattern line. Remember the pattern on the weekly is bullish. Okay. Okay, there we go. This is the 15-minute chart. So I'm focused on the overall pattern. The weekly pattern was bullish. You can see that. Pardon all the lines. I had a double bottom there on a 50%. So I had a double bottom. I call that an edge 3. So my weekly was bullish. My 4-hour was also bullish because I saw this pattern. See how that held right on that same geometric level. And so the weekly, the 240, and the 15 minutes, so this made my third bullish pattern. So that's why I'm all over that. I'm on that like white on rice, like stink on you-know-what, all over this thing when it gets to that level, right? So I'll show you how the directional line works as a trigger for us. I already know which way I want to go. I have a pretty good idea at which level I'm going to focus on, but I still need to wait for that change of direction before I know the market's turned around. Okay, I went back in time. Okay, at this point, direction is down because I'm below the high of the lowest closing candle, right? So direction is down. I'm interested in a change of direction up, but only on support. Okay, right there. See how direction changed down? If I happen to have been long, I got to get out of that trade because direction is now down. But I'm interested in a bullish change of direction on support. Okay, let me wrap it up here. Okay, right there. That's the area. Now is when I want to be a buyer. See how direction changed? Right there. Once you close above that line, now you're looking to buy dips. I showed you. I was on the 1 minute down here so I can get in right at the bottom. But on the 15 minute right there, I'm looking to buy dips at that point. I need to be long because direction just changed in line with the pattern. Once direction changes in line with the pattern, brother, sisters, you want to know that. Okay? So that's why you need to know when direction changes. That's so important because that's your trigger. But you want to know to trade when those times when direction changes in line with the pattern. Boyke, the directional line was in blue there. That's it right there. See. Hey, as always, a pleasure. And we'll as always we go over too. I apologize for that. So we'll be back with you guys next week, and we should have the site available so you guys can go in there and check it out for that 20 pips a month. FX trade, I believe so. Yeah. Vicky, I think we are. We haven't been archiving them. I think today Maud said it will be. We'll see. When would I come out of the trade? Trying trader, I'm on in this trade because it's a trend trade. I'm looking for 20 to 25 pips initially. I'll put three contracts on. I'm going to come out of the first contract 20, 25 pips in. I'm going to come out of the second contract on that orange line right there because that's a pattern line. That's a bearish pattern line. And that comes from, I think that came from all the way. Take yesterday's high. No, that's the overall move there. Good. Yeah, this market's strong. I'm going to come out of the second contract on that pattern line. Well, anywhere between the purple line and that orange line. And then I'm just going to let the last contract run based on the MACD or based on, the MACD to me or the awesome oscillator, any kind of lagging oscillator. They're all the same to me. I'm gonna let that third one run and base that third one on that. Mike, I don't. The moving, these really tight moving averages on there. Some people call them railroad tracks. That's another trigger, but they're kind of slow. I'm generally in before those go. So no, I don't. I understand the value in stocks of a 200-day moving average, and the 50 and the 200 cross. But I'm generally in long before that. I wish they came up with every single indicator you guys see are based on direction. I want to see somebody come up with indicators based on pattern, because the world trades direction, and that's why they lose so much, because you're getting whipped every little zig and zag. You got to have something. You got to be grounded. You got to stay to the center. You got to focus on the pattern. And just a simple pattern of lower highs and higher highs and lower highs is going to do it. Remember I said, hey, the mathematician or the scientist, he refers to this as a geometrical measurement, which it is. It's always the same, too. It's constant. To me, it's just marking a higher low, right? So, you got to keep it simple. And then the trend line, of course, too, Boyke. Thank you. Yeah, look at the trend line, too. That ensures there's a lot of other people there looking at that. Now, here I had a bottom, but I didn't have a trend line, right? Here, yesterday was a great trade, but everyone else thinks there's a trend line break there because, this is why I say this is proprietary. No one's using that. They're not really focusing on that. They don't know where they don't even know where that level came from. So it's just a line pointing in air. But you need to know that geometrical measurement from my perspective anyway, because you get a trend line break. Actually, right when the trend line breaks, that's when I get excited because I know I'm going to get a counter trend move and I'm going to get an opportunity to get long. Okay, thanks. Bye, everybody.